In this video, I'm going to talk about why it's important to have stock in your retirement portfolio. If you're new to my channel, I am Tanya Taylor, founder and CEO of Grow Your Wealth TV, and my channel is about saving, demolishing debt, and investing for a worry-free retirement. Subscribe to my channel below and hit the notification bell to be notified when I post new contents on Fridays and on Sundays. So the question that gets asked a lot is whether or not retirees should have stock in their portfolio. And this is controversial. There are some people that may feel that there should not be a bucket for stocks during retirement. And there are other school of thought that says that you should have stock in your portfolio, especially during this time where if you think about interest rate, it's really low. A savings account is not even earning 1%, and bonds are not doing that well either. So if you are investing in bonds or just have your money in a savings account and you think about inflation, inflation over time has been, let's say 3%, right? Just to be conservative. If you're getting less than 1% in a savings account, and for a bond account, let's say you're even getting 3%, it is actually costing you to have your money in the savings and bond account because the return that you're getting is less than the rate of inflation. Inflation is the rate at which the value of your goods and services are rising, which therefore means that the value of the dollar is falling. So here's a good example. In 1970, you were able to pay 25 cents for a what looks like an 8-ounce cup of coffee or 16-ounce cup of coffee, whereas come 2019, you're paying $1.59, and that is the result of inflation on the price of coffee over time. Yes, you want to keep bond because bond is a stabilizer. So I would not say to you don't have bond. I would not say to you don't have ETFs or index fund. You need a diversified portfolio. And the thing that you want to consider is when life expectancy is considered nowadays, you're looking at another 25 to 30 years. So if you retire at 67, you could potentially live until you are 97. But let's say you're even living until age 85. That's going to put another additional 20 years, right? You're going to have your retirement fund for at least 20 more years, give or take. If you only have it in bonds, then the return that you're going to be getting is so minimal that the amount that you're withdrawing is going to be higher than the returns that you're getting, and eventually you could potentially run out of money. So if you have a bucket, your portfolio should have different buckets. And if you have a bucket with stocks, then I always stress this, you want to invest in high quality companies that are going to be around for a long time. If you put a certain percentage in the stock bucket and you're investing in high quality companies, then you may say, okay, this is a bucket that I'm not going to be pulling money from during the first 5 years or during the first 10 years. And continue to let that grow. You also have some cash. So even though you're not getting any kind of interest on this cash, but you also want to make sure that you have that available so that you can continue to use that during this time of retirement while you're allowing this other investment to grow. And for the bond, it's the same thing. You're trying to use up some of that as well. So it's just having that balance. It's not getting to retirement and saying, I'm taking everything out of stock, because your retirement account will stop growing and you will potentially run out of cash. A couple of things that I want to say about the stock market. One is that historically the stock market has been considered the source of the highest historical return. So as you're growing your money over time, you would be getting a higher return than if you invest in the other asset classes. And also, the stock market has been shown over time that in a 10-year period, it has not returned a loss. Now, is there a risk to investing in the stock market? Absolutely, but that's when you'd also want to make sure that your money is being managed so that you are looking at your portfolio and you're balancing it as you get closer to needing to use that fund But while you are just in the initial stages of retirement, because you have such a long time before you need to use that money, you absolutely can put it in the stock market where you can get the higher rate of return, especially for the other buckets where the investments are going to be in bonds and cash where the return is going to be so low. So it's really a matter of balancing it out so that you don't run out of money in retirement. Now I know that there are other products out there that guarantees income, but that's why you also want to look at your portfolio as a whole. And in order to get some of those products, they can be very expensive. And you have to look at the cost within those portfolios and also the pros and cons of having those type of investments and whether or not they offset having some of your investment in the stock market. Now, one of the things that I did as I was putting together this video, I wanted to look to see what different fund managers are doing or recommending to their clients in terms of how they should diversify their portfolio in retirement. And as you can see from this chart, it's varied across different portfolio managers. And these are all well-known, well-recognized portfolio manager. So you have Fidelity and Vanguard, who's recommending 20% stock, and T. Rowe Price, who's saying 40% stock. Then you have Wells Fargo, who is recommended 35. So the extremes, right? Then for bonds, Fidelity again is 40%, but you have Vanguard who is saying you should put 75% of your retirement in bonds. I actually disagree with Vanguard on that one. I know that they're a great company, but I think that a retiree with putting that much in bonds is a risk because they're living a much longer life. And at 67, if you have 75% in bond, getting 3%, and even if you're withdrawing 4% or higher, most likely higher, you could stand a chance of running out of money. Now, T. Rowe Price has that range from 30 to 60%, which sounds a little bit more reasonable, and Wells Fargo has 63%. Then in terms of cash, and the definition might be a little bit different or varied across the companies, so that might be one of the things that's also causing the amounts to be different, because when they say cash, I'm wondering if they probably mean a little bit of cash and a little bit of money market funds or more liquid type asset. It doesn't say that here, but it's possible they could be thinking of that as well. So like Fidelity is saying put 40% of your funds in cash, while Vanguard is saying only 5%. So you see that big difference? That's why also it's really important that you as a individual have to think about what your needs are going to be, how comfortable you are, like which one of these would be good for you. Like for me, I know that I would not want to have 40% of my money in cash when I retire, especially if the expectation is that I might live to age 87. So sitting with someone who understands your financial picture and working with you to see how you would be able to pull from your retirement account is really critical, because then you can individualize and personalize your portfolio so that you know how much you need to have in each of these different buckets and when you're going to adjust them and allocate them and pull them out. Does that make sense to you? I suggest that you just try to understand a little bit more about this topic. Don't shy away from stocks. You just want to make sure that you invest in the right stocks that you know is going to be around for a long time. I assume that when these companies talk about stocks, that they're also talking about stocks which provides you with dividend yield, which is another form of income. Hopefully you find this information useful. Again, share with your friends, subscribe to my channel, hit the bell to be notified when I have new contents on Fridays and Sundays, and let's plan for a worry-free retirement.